Hey everyone, welcome back to Corporate Decoder. Today we're diving into Verizon's financial report. And let me tell you, there are enough numbers here to make your head spin faster than a 5G connection. That is what they want you to think. Let's decode it together. This is their 10Q, essentially a quarterly checkup on the company's financial health for the period ending March 31, 2025. It's like a report card, but instead of grades, we get dollars, debts, and a whole lot of corporate jargon. First things first, Verizon is a Delaware corporation, a pretty common choice for big companies, and their main office is in New York City, right where the action is. They're also publicly traded under the ticker symbol VZ on both the New York Stock Exchange and the Nasdaq, plus a whole bunch of notes. Fancy word for debt, with various interest rates and due dates also trade on the New York Stock Exchange. As of March 31, 2025, there were a little over 4.2 billion shares of Verizon's common stock floating around. That is after taking out the shares they keep in their treasury. Alright, let's get to the juicy bits, which are mostly in the first section regarding financial information. We'll peek at what they own, what they owe, and how they made their money. First, the condensed consolidated statements of income. It's like a quick summary of how much money Verizon made and spent. Operating revenues, so the actual money they brought in, totaled about $33.5 billion, a bit more than the $33 billion they made the same time last year. Operating expenses were also up a bit, about $25 billion, due to selling and administrative expense. This also includes salaries for employees, with operating income landing at almost $8 billion. Interest expense, what they pay on their debt, that was about $1.6 billion. Finally, we get to the bottom line with net income, $5 billion. Not bad, and a little better than the $4.7 billion they made last year. That translates to earnings per share of 1.115 cents. Next up, the condensed consolidated balance sheets, a snapshot of what Verizon owns assets and what it owes liabilities at a specific point in time. On the asset side, they have about $2.3 billion in cash and cash equivalents, but a whopping $26 billion in accounts receivable, what people owe them. Their biggest asset is by far property, plant, and equipment net, a $108 billion. This means they have a lot of cell towers, cables, and equipment that costs a lot of money. Goodwill, an interesting intangible asset that reflects the value of acquisitions that can't be easily measured, comes in at $23 billion. Now for the liabilities, they have almost $23 billion in debt that needs to be paid back within a year. Long-term debt, so the debt they have more time to pay off, that's $121 billion. That is a lot of money. Total equity, the value of the company belonging to shareholders, is about $102 billion. Next, we have the cash flow statements. This helps us understand how much cash is going in and out of Verizon. They have $5 billion in net income with almost $8 billion in cash provided by operating activities, customers paying their bills, and so on. Investing activities show $4.1 billion in capital expenditures. Dividends were paid at almost $3 billion for the quarter. Alright, let's move into the note to condensed consolidated financial statements. This is where Verizon gives us more details and explains some of the accounting choices they've made. Digging into revenue, a big chunk comes from wireless services. But here's the thing. Some customers have contracts, but most of their wireless postpaid, and wireline customers are on month-to-month plans. A portion of the total transaction price may relate to service performance obligations which were not satisfied, the value of which amounts to $53 billion, which they expect to recognize in about 3 years. Verizon is constantly managing its debt, paying some off and issuing more. During the quarter, they repaid almost $2 billion in notes that were coming due. It seems Verizon uses something called asset-backed debt, where they bundle up customer payment plans and sell them off as securities, creating new series of debt. The company's wireless licenses, those are the permits to transmit signals on the airwaves. It looks like they're capitalizing interest costs, which means adding the interest expense to the value of the license while they're still getting it ready for use. The value of its goodwill intangible assets that do not have physical substance also is very standard, but it is worth mentioning it is net of accumulated impairment charges of $5.8 billion related to their business reporting unit. Finally, they do have access to credit facilities, including a $12 billion revolving credit facility, which is good to have in case they need quick access to cash. Now, for the legal section, they're involved in the usual lawsuits, including a bunch of patent infringement cases. Nothing major seems to be brewing, but they are always a risk to keep an eye on. One final note, as of March of 2025, Verizon says it has 28 renewable energy purchase agreements to meet their green initiatives. The company, like any other of this size, has post-retirement healthcare and life insurance plans for employees. Looking at the equity side, Verizon is not messing with shares, but are just paying them out. So shareholders are happy to see dividends declared at about 67 cents per share for the quarter, totaling $2.9 billion. So what's the story here? On the whole, I'd give Verizon a C+ on this quarter's report card. The key strength is their consistent large revenue. They are basically a big train that keeps on rolling, and the weaknesses are their growth, as they seem to be struggling to find large sources of future growth, as reflected in relatively small changes and negative signs in new subscription numbers. This can become a real problem in the long term, since other companies will be more aggressive in gaining new markets. Their biggest risk appears to be how well they can manage their debt load while continuing to invest in the infrastructure necessary to maintain a competitive advantage. They also need to pay attention to public work plans, as those are a source of revenue that they need to protect, and to public work plans as those are a source of revenue that they need to protect. So in conclusion, Verizon is stable, but they need to show some innovation to excite shareholders and prove they can still grow in a very competitive market. That's it for today's episode. Make sure to subscribe, like, and comment for more of the Corporate Decoder. See you all next time.